Welcome to the GSMC Business News Podcast, the show dedicated to keeping you up to date on all things concerning business, technology, and the stock market. Get a head start on the day as we keep you updated on the latest goings-on Wall Street, money, jobs, and technology. If you're looking for a podcast to keep you informed and ahead of the game in business, the GSMC Business News Podcast has you covered.
Hello, everyone, and thank you for tuning into the GSMC Financial News Podcast, brought to you by the GSMC Podcasting Network. I am your host, Chris Mitchell. There are a lot of four-letter words that I'm not supposed to say, but today, there's one three-letter word, just a way to describe what's going on in the financial world right now, and it's wow. I wish I could come up with a better way or a more creative or clever way of saying it, but just wow. The market is in a complete and total anarchy right now. You know, financial outlets, financial industry, the whole market in general is supposed to survive and thrive based on stability. We have none of that right now. And that's just leading to more and more craziness, more and more lunacy, more and more instability, which is kind of remarkable because anyone that you talk to, from the White House to everywhere else, the economy is doing well. Some will say extremely well. Some would say great. The fundamentals of our economy are doing great, and yet the stock market is in free fall in some markets. If it's stable, if it's basically doing nothing, that's a significant gain. That's how weird today is in the financial world. If you're doing nothing, if you're just holding pace, then you're actually succeeding today. If you're in the energy market, you are having a horrendous day. And again, that is surprising to see. Because job growth for February, people aren't even talking about it. This should have been maybe the story of the month, should be a story for the next 6 months. In the economy, we gained 273,000 jobs in February, which is a very good number. Not exceptionally crazy good. During the Obama administration, they had plenty of 200,000 plus job months. But they were expecting something in the neighborhood of about 175,000, and they ended up getting 273,000. So almost 100,000 more jobs were created in February than was expected. And that's fantastic. That is a really good month. Even people who don't want to give credit to the presidency and President Trump in their work with the economy, they can't help but admit that is a very good month. That's a very good number. And yet the stock market today dropped 7% prior to trading. So it dropped 7% prior to trading, which created a circuit breaker. They're calling it. That's what it's called. That it clinched what's called a circuit breaker. So the market did not open at 9 o'clock because of prior trading. Prior to opening, the trading was down by more than 7%. So a circuit breaker was created, stopped trading, and then slowly, about 15 minutes into the market open, companies started to allow their stocks to be traded. So trading started to get going. And because of the 7% drop and then the halting of the markets, that actually did result in a 500-point increase. A 500-point increase at the start of a market, I would say, is a pretty robust beginning to the day. But that was a 500-point raise after a 7% drop, and the markets have just been collapsing ever since. So even though it went up 500 points at that time, as of noontime on Monday, the market was down 1,500 points. So it was down 7%, came back up 500 points, and now it's down 1,500 points for the day. That's what we're going through right now in the stock market, in the financial news. And so that's what we're going to be talking about today. We're going to be talking about the effect of the coronavirus. We're going to be talking about the Fed and the way that they've cut rates before and the way that they're cutting rates now. We'll look back a little bit at the way that pandemics and other outbreaks have impacted the stock market and impacted some of the growth of economies and things like that. We'll also talk a little bit about the mortgage rates because a lot of us aren't in the stock market. a lot of us aren't impacted significantly the market, or little blips like this, because most people do believe that eventually there'll be a correction. But a lot of people who invest over the long term rather than they're day traders or trying to make short term, essentially bets on the goods and the bads of the market and the futures and things like that. So a lot of us don't participate in that element of the stock market. For those of us who just invest for the long term, we just ride it out. Our portfolios take a hit for a while, and then our portfolios get it all back, and then we actually gain. That's the idea. But the mortgage rate, the mortgage industry is one place where people can actually kind of make money. And really the way that you make money in the mortgage industry is that you save money. You reduce your interest rates, you even possibly go to an adjustable, or you just refinance and do a better rate for your fixed. And you can save significant amounts of money there. You can save $100, $200, $300 a month by refinancing down depending on what your interest rate is. So we'll talk a little bit about that as well. So that's on the agenda today. I'm your host, Chris Mitchell. If you want to follow me on Twitter, you can do that at CJMitch73. Let me go through some of the information that we've had today. Just give you kind of a rundown of the facts and figures of the day so far here. Again, it's been a crazy day in the markets. So let me just give you some facts, give you some information, and maybe give you some perspective on what exactly is going on here, because it's just crazy for those of you out there who don't even pay attention. It's a crazy day for anyone, regardless of what it is. So just give you an idea. Today's Dow is the worst day in the Dow since December of 2008. Today is the worst day in the Dow Jones Index since December of 2008. We're talking, 11 and a quarter years. It's at the lowest it's been since January of 2019. So that's a couple months. That's not as crazy, but nonetheless, it's down over the last 2.5 months. The S&P 500, it's having its worst day. The Dow is having its worst since 2008. The S&P is having its worst since August of 2011. So it's been about 8.5 years since the S&P has been this bad, a day this bad. So it's been a long time since they've had a day this bad in the S&P. So it is, again, the craziness of the day, just to give you some perspective on what exactly is going on. Also, the major averages, they're down about 19% from record highs. So because of the success of the economy and how good everything has been going, we've been on highs and hitting new highs, and every single month it seems like we're hitting a new high in the stock market. Well, we're down 19% from previous record highs. So that's a meaningful day. And bank stocks are who are getting hit the most. Energy and bank stocks are the ones that are really taking the hit. And it's been a perfect storm. The coronavirus is a significant portion of what's going on, but also what's happened with Saudi Arabia and OPEC and the oil industry. Saudi Arabia has been trying to convince all of the OPEC companies to reduce their supply, to reduce production in order to raise prices, because they believe that according to their evaluation, there's about 3 million barrels of oil in excess out there on the market. And so that's artificially and I guess, I don't know if they'd say unfairly, but against their interest, there's just too much oil out there, so it's too cheap. Gas is too cheap. In general, it's just hammering them. So Saudi Arabia wants to reduce production, and being blamed for the fact is that Russia says, no, we don't want to reduce. Now, that's who's being blamed right now, and again, who knows exactly who's to blame, but Russia walked away from the table. They did not agree to reduce production, and because of that, essentially a price war is going on, and Saudi Arabia has decided to push this. Interesting time to push it, because you've got coronavirus hitting the entire world, and now they decide to just throw this into the mix to make things even more and more muddied. But just to give you an example of bank stocks, Bank of America is down 37% from its recent high. So 37% from recent highs. And a lot of that has to do with the coronavirus. And again, and another part of it is because of this recent, essentially a trade war between Saudi Arabia and Russia and the OPEC corporations there. And the Bank of America has a lot of exposure in the energy market. So the impact on oil and this kind of weekend development that's now impacting everybody on Monday. So the banking industry is taking a hammering because of that, and Bank of America specifically is taking the worst of that. And it's raising concerns. And again, the stock market relies on stability. So anytime there are concerns or risks or unknowns, uncertainty, that creates panic. It's natural. That's what the market is. It's a bunch of panicked people and doing, spur of the moment decisions that are not always good for the long term, not even always good for the short term, but they just panic, and it creates a lemming effect. That's kind of the way the stock market works. It goes up and down based on the whims of investors. And some are smart, some are not smart, some are stable and reasonable and measured, some are not. Some are quick and aggressive and bold. Some would say stupid. Bold sometimes is extremely good, and sometimes it is extremely bad. But either way, what it is it causes volatility, it causes instability, and it creates a day like this, which is complete and total lunacy.
Are you looking for a podcast that gives you all of the latest news from the world of finance? Then check out the GSMC Financial News Podcast. We'll delve into the ups and downs of the stock market, changes in the economy, and news from the world of real estate and technology. From breaking news on the New York Stock Exchange, NASDAQ, or the overseas market, to updates on the bond market, if there's money to be made, we'll cover it on the GSMC Financial News Podcast.
So there are concerns that with this recent perfect storm of casualties here, that the crash could be as bad as it was in bank stocks in 2016. We've heard that whispered out there, and you're probably going to hear that anytime there is a rambunctious day. Anything unstable, things like that, you're probably going to hear these kinds of discussions. 2016 is a historic day period. 2008, the financial crisis, things like that. Again, another one that you'll get a lot of comparisons to. So we're hearing that, but from listening to some of the experts a little bit, it doesn't look like that's the case. So anyone who's familiar with 2016, where it doesn't look like we're in the circumstances of the industry aren't as such as it was then. So even though the instability and the craziness is maybe similar, the underlying factors are not. One example being capital liquidity was not very good in 2016. We saw that a lot with the financial crisis, is that people were investing and there was debt all over the place and nobody had any liquidity, so they couldn't get out of their problems or they couldn't weather a storm. Well, today we have a lot more capital liquidity than we ever did. They put in a lot of regulations when it came to demanding that from the banks and things like that. And so banks, even though in recent years they've cut into some of those regulations that were put into place after the financial crisis, a lot of it is still there. So capital liquidity is required to be higher, and therefore there is more capital liquidity in today's market. So you're seeing that. That's one thing that's different from 2016. Another one is that the epicenter of today's issues are not financially based. It's not a fundamental, foundational problem within the banking industry. It's the fact that Saudi Arabia and Russia can't agree to reduce production in oil, and the fact that the coronavirus is hitting the entire world, and over the next couple of weeks is probably going to be significantly worse than it is right now. Because America, as of right now, still doesn't fully grapple with the idea that this virus is here as badly as it is. Everyone's concerned about it. A lot of people are concerned about what's going on. I was supposed to go to a hockey game with my father this weekend, and my father is a high-risk person as far as if he was to get infected, there'd be serious risk to his life. So even though most people think it's probably fine to go to these games, and a lot of people, from what I've been able to read, if they go, they'll get it. It'll be maybe a severe flu or something like that, and then you'll get over it. But my father's a high-risk situation, and if he got it, he may actually not survive. So we decided not to go to the game. So there is a level of panic and concern in America, but the cases are nowhere near what we're going to have in a couple of weeks. The testing kits are at extremely low numbers. People aren't testing positive at anywhere near the rates that we should see already because people just aren't being tested, or in some cases, the testing was actually wrong, where people would come back as if they had tested negative but it turned out that they were positive. So the tests are actually, for a while, they were actually incorrect. And that just leads to more exposure. It's a very contagious disease. So that just resulted in more and more people ending up with the disease that probably wouldn't have got it otherwise. So that concern is going to go up going forward. But even the concern that we have now is having a significant impact on the stock market because everyone looks at it and sees, okay, people aren't going places. People aren't spending. People don't want to go to hockey games. People don't want to travel. Nobody's going anywhere near a cruise ship. And doctors and the CDC are even telling you not to. So all of these different things are just signs that recession and regression in spending is coming. So those are kind of what is fueling the problems in the market right now. So if it was a fundamental problem with our economy or a fundamental problem with the stock market or a fundamental problem with the lack of liquidity in the banking industry, which was a major concern during the crisis that almost brought down the entire world, if those fundamental structural issues existed, then you could see how this panic would be much more justified. Whereas right now, it looks like it's more of a blip, but nonetheless, we don't know how long it's going to take. Russia, for whatever reason, doesn't want to reduce production. There's some speculation about what that is, and I'll get into that going forward. But it's just looking like it's just a perfect storm of consequences and circumstances that are creating a bad situation at the moment. So let me give you some more details about what exactly is going forward and some of the things we should be concerned about as we move forward here. On segment 1 of the program. I'm your host, Chris Mitchell. Hopefully you're enjoying the Financial Times by GSMC here. The S&P is down nearly 20% from its peak. And one of the concerns when it gets to that is that if you get down 20% or more, that means there's a 60% chance of a recession. Everyone hates that word recession. Everyone says, all right, the economy is eventually going to recess. We're going to have another recession. It comes and goes. We always have these ebbs and these flows, these ups and these downs. With growth, eventually comes recession. So a recession is coming eventually, but nobody wants it to actually happen. Once the S&P is down somewhere near 20%, that is a good indicator that a recession is possibly coming. It at least puts it up to a 60% number. So as of today, if it isn't just a weird little blip created by lunacy and insanity, if this was some kind of fundamental economic circumstance situation in America, then we would be 60% more likely to have a recession in the not-too-distant future than normally would be the case. So that's a concern. Now, one of the things that I found interesting, I was watching a program on CNBC this morning, the global financial markets, the markets themselves, the roulette wheel that is the stock market, but the global financial markets, and we're talking everywhere, not just America, the entire global financial markets, they are 4 times larger than the actual global economy. So the global economy is 1/4 the size of the actual financial markets of the globe. So the markets are bigger than the reality. So it's like you ordered 1 pizza, but everyone's behaving like there's 4. So they're bidding on it. They're saying, I want the pepperoni, I want this. The financial markets are 4 times larger than the actual global economy. So when you've got fears that are going on, it may not actually be existing in the markets, in our economy, but it exists in the minds of investors. So that creates all this instability, all this craziness that's going on. It's all in the minds of investors, even though it's not actually happening on the ground. So oftentimes the reality has nothing to do with what's going on in the minds and the behaviors of the financial investors that participate in this enormously large global financial market. So these fears can create behaviors in the stock market, which then can actually impact the global economy. So the tail is kind of wagging the dog here. Rather than the economy dictating what's going on in the markets, because the markets are so large and so much larger than the economy, the market itself can actually dictate what goes on in the actual economy itself. So that's a concern that I think we need to watch out for going forward. That's, I think, one of our societal problems in the whole. But it's really just amazing that people essentially betting on the economy are 4 times as much volume as there is in the actual economy itself. That's ridiculous. Like $4 million is being bet, even though the economy only has $1 million in it. That just to me is total insanity. So going forward, here are some concerns that we need to be thinking about and looking at future jobs numbers. Because again, a fantastic job numbers in March. I expect the March numbers to be okay, and then I would think the real impact of these numbers could be in April. So that's something you got to look at going forward: is job losses, layoffs in the travel industry. How badly does the travel industry just get hammered over the next 2 or 3 months, 6 and 9 months, and then across the next year? Because we don't know exactly how long coronavirus is going to impact us. They think could be even a year. Some people say it'll be more short term, that the summer comes and it could change, but job losses, layoffs, things like that, these are all things we need to be concerned about going forward based on just what we're seeing today. Here are some questions that I have that going forward, hopefully we'll be able to address in future podcasts. How does the government assist citizens, and how does it stimulate recovery for day-to-day people? Because people are going to stay home. They're either going to be laid off, they're going to be fired, or they're going to work from home rather than work in the office. Businesses around different economic centers are going to be less active. People aren't going to be going to work in all these working hubs, and all the businesses that exist around them are going to be negatively impacted. How does the government put together programs, incentives, tax breaks, subsidies, whatever? What kind of policies do they put in place to assist everyday people and businesses that are going to be negatively impacted by this? It's not just to stop the virus. How do you deal with the economic impact of it? How do you save the travel industry? I mean, if no one is traveling, and JetBlue, for example, is refunding all tickets in today's flying world, what do you do to help them survive so that when this is gone, they aren't gone? We need to save these patients. So how is the government going to help workers in some of these businesses to stay afloat and survive through this extremely difficult time? And they couldn't have predicted this. You cannot blame a pizza place in your local hometown or JetBlue or American for a coronavirus destroying, their industry. It's one thing to invest poorly or be gluttonous in your spending or inefficient in the way that you do things. Those are things where you deserve to suffer, and your business should either succeed or fail based on how you handle those kinds of things. But who could have predicted a coronavirus that would possibly cut 75% of world travel or more? I mean, who could have predicted that 3 years ago? I mean, so what is the government going to do with their economic and monetary policy to help with that and to help with them? So that's something that I'm looking forward to. The $8 billion that was given to the to help fend off the coronavirus in America by Congress, there was some money in it for that kind of thing, for subsidies and for stimulus, but it was only about $500 million. So there was $8 to $8.5 billion given to fight the virus, but only about $500 million to help stimulate and maybe help save some of these people that are going to be negatively impacted on the economic front. That number probably needs to grow exponentially. So I'll be curious to see what happens going forward when it comes to that. You're listening to the GSMC podcast as part of the GSMC Financial News Podcast Network. I'm sorry. This is the GSMC Financial News Podcast brought to you by the GSMC Podcasting Network. I'm your host, Chris Mitchell. We've been talking about the coronavirus and the impacts and the craziness that's been going on in the stock market. When we come back, we'll talk about the markets, what's going on. I'll give you more tidbits and information. We'll talk about the oil industry, the energy market, and we'll talk about the fight, the trade war that's going on between Saudi Arabia and Russia, and some of the impacts and some of the details about what exactly is going on there. So we'll talk about that when we come back. Thank you very much for listening in.
Do you work in the world of marketing and advertising? Are you a media buyer or the owner of an agency? Have you been looking for a podcast to help stay on top of all the goings on of those worlds? The GSMC Marketing News Podcast is dedicated to keeping you up to date on all things concerning marketing and advertising. Get the latest marketing news, from what major businesses have planned for the coming year to the newest trends in advertising, from podcasts, digital and streaming, to the old standbys of radio, television, and billboards. The GSMC Marketing News Podcast has you covered, whether you're a marketing agent or a business trying to expand your brand.
everybody, and welcome back to the GSMC Financial News Podcast, brought to you by the GSMC Podcasting Network. I'm your host, Chris Mitchell, and we're talking about the coronavirus and the impact on the financial markets and the wild and woolly day that's been going on with all the drops in the market and the slamming of the different energy in the financial markets and the banking industry and the banking markets. We're really having an eventful and crazy day. And what made today worse than it ever, the markets are probably going to slowly be down with some blips, because the markets always are going up and down. But because of the coronavirus and the fears and things like that, for the most part, I would expect the markets at least to slow down their improvement and their growth. And we may see, over time, probably even some drop in the markets overall. But today was an epic. They didn't even open the market on time because of a circuit breaker was clicked because there was such a large drop before trading even opened. So the market dropped 7% before anyone was even allowed to trade on the day, the pre-day trading. And one of the reasons was the oil. Saudi Arabia they were having a meeting, and Saudi Arabia wants to reduce production because there's too much oil out there already. They're producing too much. The demand isn't there, and so because there's an oversupply and a lesser demand, prices are at levels that they just don't think are healthy. Saudi Arabia doesn't think it's healthy. They tried to convince everybody that's part of OPEC to agree with them, and Russia was unwilling to agree. Now, one of the motivations people suspect is that Russia's unhappy with America's sanctions on them, and so they're trying to destroy the shale industry. The thought is that if gas prices and oil prices remain low, that the shale industry will go bankrupt. This, I would think, would take a little bit of time. It's not going to happen over 2 or 3 days, but if that's the case, if that is Russia's plan, I don't know if it is, but there's been speculation that maybe that's what they're doing. Maybe they're willing to cut off their nose in order to spite their face. They may be willing to do that. There's some speculation that that's the case, and there's some speculation that it doesn't make any sense why they would do that. Maybe this is their bargaining strategy, is they walk away from the table only to come back and hope for a better deal. You see that a lot with the Trump administration, the way that they handle their dealings when it comes to negotiating trade deals and things like that. So maybe that's what Russia's doing. Maybe this is just a bargaining ploy. But whatever it is, the oil markets are down 25%. It's the biggest drop in crude oil since the Gulf War in 1991. So Russia walking away and refusing to agree, and Saudi Arabia's pushing of what's going on right now, that has resulted in an enormous drop in crude oil. And again, going all the way back to the Gulf War in 1991. We went to war, and because of this little move by Russia, the impact on the crude markets has been the equivalent of that. That's really kind of remarkable. The S&P energy sector is also plunging, and that's energy in general. Of course, if oil and gas is being impacted, then of course all the other sectors are going to be impacted. And for the most part, we see that it's mostly negative. There are some industries like natural gas is actually staying stable. It's not like they're booming, but they are staying stable. And in today's collapse, stable is considered winning. And so the natural gas industry, the sector, is doing, again, quote unquote, well, based on the craziness of what's going on today. But most of the other sectors are not doing so well. So that's what we're seeing when it comes to that industry. Obviously, oil is a significant part of everything. Gas and oil, supposedly every time we go to war, it's because of oil. So when they're talking about supply and demand, and this kind of strikes me as kind of strange, that they're allowed to manipulate the entire industry. So they can sit down as a group, legally, and decide how much they're going to produce so that they can control the supply and therefore control the demand and therefore essentially manipulate the pricing. That's not supposed to be allowed. We're not allowed to do that. You're not allowed to do that in America. I don't think anytime, for many years and many generations, we've seen China labeled as a currency manipulator, that they manipulate their money in order to impact a whole bunch of different things. But it significantly impacts global trade, borrowing rates, treasury bonds. when different economies manipulate their currency, it has a worldwide impact on so many different industries. And that's what Saudi Arabia is trying to do, and yet it's allowed, and this is commonplace. It strikes me as kind of perplexing, but that's just the way that it works. So it really is interesting for me, to say the least. Just to give you another idea, energy stocks are down 15%, the worst of any industry. And an odd, incongruent fact, as I just said, natural gas is actually up, or at least stable, while the rest of the industry is down. That is very strange, and nonetheless, it's bad. They talked about the shale industry. There have been some analysts who have probably been a little bit overly aggressive and probably scaring people a little bit more than they probably should. But some analysts have said the shale industry is going back up. They're screwed. Again, if Russia comes back to the table and they reach a deal on Friday, I'm sure that everything will be fine. But if this is a long-term plan and that is Russia's goal, there are some analysts that believe it's going to work and that the shale industry is completely and totally screwed. Another impact, low oil prices actually hurts the fracking industry. It reduces our demand on our own oil production as well. It allows it does allow Americans to buy oil and gas cheaper. So from that perspective, it's a good thing. Gas prices stay low. But if you get too low, there are also negative impacts for that as well. And for those of us out there who hate Russia, it hurts Russia. So even though Russia is doing this, low prices hurt them. Russia's main export is oil and gas. So when prices are low, that significantly hurts their economy. And yet, for whatever reason, they're actually deciding to not reduce production. That's one of the perplexing ideas, and that's one of the bases for why some believe that this is a temporary thing rather than a long-term, is that maybe they're just doing it to have an impact, but not to literally, that it's not a long-term philosophy or strategy. So that's one thing that's kind of leading the discussion about what's going on here. I'm your host, Chris Mitchell. This is the GSMC Financial News Podcast, brought to you by the GSMC Podcasting Network. You can follow me on Twitter at CJMitch73. When we return, I'll talk about the Fed and how they've cut rates and how they're expecting to cut them again, what the impacts are, what it means, what it's supposed to mean. Ex-Goldman Sachs CEO Lloyd Blankfein has had some interesting thoughts in the last week or so. Stephanie Ruhle, an analyst and an ex-Goldman Sachs employee who now works for MSNBC, has had some interesting opinions about what exactly the Fed is doing and the impact of what it could do and whether it will achieve what it's intended to achieve or not. So we'll talk about that when we come back here on the GSMC Financial News Podcast.
You've been listening to the GSMC Business News Podcast, part of the GSMC Podcast Network. You can find this show and others like it at gsmcpodcast.com. Download our podcast on Apple Podcasts, Stitcher, SoundCloud, and Google Play. Just type GSMC into your favorite podcast app to find all of the shows from the GSMC Podcast Network. From movies to music, from sports to entertainment, from business news to weird news. Please subscribe to the podcast and follow us on Twitter and Facebook. Thank you, and we hope you have enjoyed today's podcast.